Welcome back to the deep dive. We have a really fascinating stack of source material in front of us today.
We really do.
It's a detailed, chronological look at the quarterly revenue trends for a major technology organization.
Yeah.
We're covering 8 financial quarters, specifically running from Q4 of fiscal year 24 right through to Q3 of fiscal year 26.
And this deep dive, it's really about the financial architecture of the company.
Right.
Our mission is pure data archaeology. We're going past the headlines, past the general market commentary to see what the numbers themselves actually reveal.
So we're trying to figure out what's really going on under the hood.
Exactly. We need to identify and quickly which segments are providing the engine for this massive, explosive growth and, which ones are offering that necessary but maybe less flashy foundational stability.
And the scale of this transformation is, well, it's truly stunning. This isn't just about a few successful quarters.
No, not at all.
It's about a radical, almost fundamental shift in the composition of the entire business. Just look at the bookends of this 2-year period. Total revenues started at around, $22.1 billion in Q4 FY24.
Right.
By the time we hit the most recent data point, Q3 FY26, that total revenue had soared to over $57 billion.
To put that in perspective for you, that's more than a doubling of the entire enterprise in just 8 quarters.
It's incredible.
And when we look at the overall growth trajectory, what stands out immediately is the acceleration itself. I mean, the company had a strong first year, finishing FY25 at nearly $39.3 billion.
Which is solid growth from their starting point for sure.
Absolutely. But if you zoom in on that second year, fiscal year 26, the curve goes from strong to, well, you said it.
Absolutely parabolic.
Right.
That recent acceleration is the core story here.
It is.
Let's look at the 3 most recent quarters in our data. So Q1 FY26 was already impressive, bringing in roughly $44 billion.
Which is a huge number on its own.
Then Q2 climbs to nearly $46.7 billion. But then came the true surge, an almost unprecedented ramp-up.
Soaring to $57 billion in Q3 FY26.
Exactly.
And that is the data point that demands attention. The increase just from Q2 to Q3 alone is a massive, sudden injection of more than $10 billion in revenue.
In a single 3-month span.
Right. And if you track the last 2 quarters together, we're talking about an almost $13 billion increase in the overall run rate. It's hard to find comparable acceleration in major tech financials.
So this raises the critical question that this whole deep dive really hinges on. If total revenue is spiking like this, which single segment is responsible for driving this kind of historic rapid increase? You don't get a $10 billion sequential jump by accident.
And this is where the data center or DC story moves from, interesting to industry defining. We don't have to look far for the primary driver.
Not at all.
The DC segment is the undisputed leader, and by the end of this 2-year window, it just absolutely dwarfs every other part of the business combined.
Let's put some numbers around that dominance. So back at the start of our period, Q4 FY24, data center revenue was, $18.4 billion?
Right, a very strong base to start from.
But compare that to the most recent total we have, $51.2 billion in Q3 FY26.
That delta, over $30 billion, that is the primary source of the organization's overall success.
Is the story.
And what's truly fascinating here, and what you really must take away, is the proportional insight.
Okay.
When we talk about that final total revenue figure of $57 billion in Q3 FY26, the data center segment alone accounts for $51.2 billion of it.
Wow.
It confirms that this company hasn't just grown, it has rapidly and successfully restructured its core identity to focus almost entirely on this one infrastructure market.
It's a complete pivot. And that famous $10 billion quarter-over-quarter leap we mentioned in the overall revenue?
Yeah.
It's entirely attributable to the data center segment. Let's walk through its performance in FY26 to show this unprecedented speed. Q1 was huge at $39.1 billion.
Already massive.
Q2 was strong at $41 billion.
But here's where it gets really interesting. That Q3 number of $51.2 billion represents not just aggressive growth, but almost flawless operational execution.
What do you mean by that?
That nearly $10.1 billion sequential jump suggests an event.
An event.
Either the fulfillment of massive pre-existing orders for AI-related infrastructure, or a sudden, dramatic increase in demand that the company was just uniquely positioned to satisfy.
So we can infer that this massive spike is directly tied to the exploding demand for specialized computing.
the AI chip market.
Right, the AI chip market, supporting the training and deployment of large language models globally. The numbers are basically the financial manifestation of the AI gold rush.
Precisely. If we were to connect this to the broader picture, this single jump represents not just a successful quarter, but a structural shift in global computing investment.
So this is bigger than just one company.
Oh, absolutely. It implies multi-billion-dollar buildouts of AI infrastructure happening in real time, and this company's data center segment is capturing the lion's share of that new market value.
Okay, we've established the data center as the rocket ship. Now let's shift gears completely and look at a segment that has historically, defined this organization, but now stands in stark relief to the sheer scale of the DC surge.
You're talking about gaming.
I'm talking about gaming.
Right. Gaming provides a crucial counter-narrative. It shows us volatility in market cycles rather than that parabolic infrastructure-driven growth.
So it's a different kind of story.
A very different story. They started strong in Q4 FY24 at nearly $2.9 billion. However, they hit a notable dip right in the middle of our time frame.
They did, down to $2.5 billion in Q4 FY25.
And that fluctuation often reflects, consumer hardware refresh cycles or broader economic slowdowns that impact discretionary spending.
That market turbulence didn't last, though. If you track the recent resurgence, gaming revenue climbed dramatically throughout FY26.
It did.
Yeah.
It hit a high point of nearly $4.3 billion in Q2 FY26 and maintained that strength at $4.26 billion in Q3.
That is a substantial two-year increase, growing by over $1.4 billion in absolute terms.
And if you look at gaming in isolation, this trajectory is absolutely a success story.
For sure.
Growing revenue by 50% over 2 years is outstanding performance in a mature consumer market. But if we connect this to the bigger picture, its absolute contribution, though substantial, is now only a tiny fraction of the data center segment.
Right. It really highlights the difference between, let's say, structural healthy consumer growth, which gaming represents, and what we might call disruptive infrastructure growth from DC.
That's a great way to put it.
And it's important to understand that the success of the data center doesn't negate the success of gaming.
No, not at all.
It merely renders it proportionally smaller.
Now, let's turn our attention to the segments that they rarely grab headlines, but are crucial indicators of long-term strategic health.
The consistent climbers.
The consistent climbers. Exactly. We can start with the auto segment.
When we talk about auto, we're looking at a market defined by long design cycles, regulatory hurdles.
Stringent safety standards.
Right. Growth here is not explosive, it's deliberate. In Q4 FY24, the auto segment brought in a modest $281 million.
But by Q3 FY26, that number was $592 million.
That's nearly double.
That is disciplined growth, nearly doubling its revenue over the 2-year period. And what's impressive is the stability in the most recent reported quarters.
So let's look at those.
It was $567 million in Q1 FY26, $586 million in Q2, and then $592 million in Q3.
So very steady.
This sequential stability suggests firm, predictable traction, likely driven by major design wins in autonomous driving platforms and, in-car intelligence.
This type of stability is a completely different kind of strength than the volatility we saw in gaming or the explosion in data center.
It is.
It suggests predictable, sticky revenue that will compound over years.
Absolutely. The auto segment's structural growth signals that the company's technology is becoming embedded, a fundamental component of the next generation of vehicles.
You don't see massive spikes here.
No, because regulatory rollout and product integration, they just take time. But the doubling of revenue is a profound statement about their long-term position.
Similarly, let's look at professional visualization, or PV.
Okay.
This segment also demonstrates a slow, deliberate, quarter-by-quarter increase, suggesting a more mature, predictable market. It started at $463 million in Q4 FY24.
And rose consistently through every single quarter, eventually reaching $760 million in Q3 FY26.
It's another story of steady progress.
Professional visualization is the segment that speaks to the steady needs of industries like architecture, engineering, manufacturing. It's not flashy, but tracking its progression through every quarter in FY25 and FY26 shows a reliable upward trend.
The definition of structural growth.
Exactly. Slow, steady, and based on underlying industrial demand rather than, say, consumer hype or these massive infrastructure deployment waves.
And we should briefly mention the smallest segment, OEM and other.
We should.
While small in absolute terms, starting at $90 million, It mirrored the strong proportional growth we saw elsewhere.
Almost exactly doubling its revenue to 174 million in Q3 FY26.
So it's part of the same story.
This is a powerful unifying data point. It confirms that the underlying demand for the company's technology, whether it's specialized chips for AI, GPUs for gaming, accelerators for professional design, it's pervasive across almost all revenue channels.
Everything is growing.
Everything is growing. The real story is just the rate and the magnitude of data center growth.
So what does this all mean when we put the puzzle pieces back together? Let's revisit the final numbers from Q3 FY26. We had data center revenue at $51,215 million.
Right. Now, if we total up the revenue from every other segment combined,
So gaming, professional visualization, auto, and OEM.
all of them together, that total comes to approximately 5.8 billion.
That is the defining proportional insight. The data shows a decisive, radical shift where the revenue from one segment completely overshadows all others combined.
By a factor of nearly 9 to 1.
Wow.
And while that dominance is a testament to extraordinary market capture, the important nuance for you, the listener, is the strategic implication.
Which is?
While data center drives the overwhelming majority of the total revenue increase, all other core segments, gaming, auto, and PV, are still showing solid multi-quarter growth trajectories. They are structurally sound and healthy.
However, this concentration does raise a valid challenge, doesn't it? Does the sheer magnitude of the data center success mask a strategic vulnerability?
That's a great question.
I mean, if this market were to pause, if, say, the global build-out of AI infrastructure were to hit a temporary ceiling, the resulting impact on total revenue would be far more dramatic than it would have been 2 years ago.
That's the critical takeaway. Data center is not just a growth driver. It has become the only growth driver of scale. The company has bet its future successfully so far on leading the AI infrastructure arms race.
So that acceleration trend is the real story.
It is the financial story of the decade.
Speaking of acceleration, if we had to pick the single most surprising fact from this entire deep dive, it would have to be that massive, almost unbelievable $10 billion jump in data center revenue.
In just the third quarter of FY26.
Yes, that level of quarter-over-quarter execution, it fundamentally changes how we view technology scaling.
Indeed. And it leaves us with this final thought for you to consider based purely on the structure of the data.
Okay, let's hear it.
Given that total revenue growth is now almost entirely driven by the data center's parabolic infrastructure-driven curve, what does the stability and steady doubling of the smaller segments like auto and professional visualization suggest about the necessary dichotomy of the modern tech market?
An interesting question.
Are stable, structural segments destined to become strategically irrelevant to investors who are only focused on exponential market-disrupting growth? It forces us to reflect on what we value most when analyzing the future of technology.